Value investing professor and investor Bruce Greenwald says that value simply not the best place to be right now. Professor Greenwald teaches value investing classes at Columbia, features guest speakers including Warren Buffett, Michael Price, Mario Gabelli, and others nearly every year. And he joins us now. Professor, good to see you again. Thanks for coming on.
Good to be here.
Well, is it a good time to be a growth? Is it hard for you as a value guy to say growth might be the place to be right now?
It's never hard to say anything as a value guy. That value is about looking intelligently for bargains. The reason normally you're not interested in growth is that the most brutal fact about the market is that whenever you buy a stock thinking it's going to do really well, somebody else is selling that stock thinking it's going to do relatively badly, and one of you is always wrong. When you look at growth stocks, people have historically always overbought them. They are the lottery ticket stocks historically in the world. People have bought lottery tickets in every society, and in every society there's crappy investments.
But some people do win lotteries, right. And some people have made a lot of money buying growth in the last 10 years.
Right, and lotteries have always been crappy investments on average. So
is that a technical term?
I think that's right.
Crappy.
So I think what you want to ask first about growth is why now are you likely to have somebody on the other side of the trade who's not seriously thinking about it? And I think there's a good answer to that question. $1.5 trillion have left growth stocks to go to hedge funds.
That's it.
You can't collect 2 and 20 buying the big traditional growth stocks, and there's not a lot of money to replace it. There's a lot of closet index money, and there's a lot of momentum money. So this seems to be the time where you're likely to be on the right side of the trade.
And you believe that now, again, value is in the eye of the beholder, but American Express is a great play right here.
I think that's right. I think the second thing about a value investor is that the environment creates the opportunity. But if you're a value investor, you know what you're buying. What you're buying for American Express is basically at 17 times next year's earnings, a 6% return. They give you 4% of that in cash and buybacks and dividends. So that's 4% on your money. They reinvest too, and if you're serious about the growth game, part of your growth is always going to come from good capital allocation, and they are phenomenally good at that. They probably earn twice their cost of capital at a minimum, so every dollar they reinvest produces $2 in value.
This is not a double, in a year, but this is a good return for your belief.
I think that over time, depending on whether the market gets smart or not, this is a stock that yields about twice what the average market is yielding. Now, I don't know how you describe that as a double or not, but you get 4% in cash, the reinvestment is worth 4% a year, and then you get organic growth in billings just for free, which is another 7% because they're on the right side of every long-term trend. Their customers are rich people, not poor people, as opposed, say, to Walmart.
Well,
and they're selling services, not goods. And both those are long-term trends. You start with 5% GDP growth, 4.5% GDP growth. You add that, that's a 15% return. In a market where the average return is probably 8%, I don't know if you'd call that a double, but I would call that a phenomenal opportunity.
Okay, well, let's talk about the other name you mentioned, Walmart, because you think this is a classic value trap. In other words, a lot of times when you're the massive player in one space, people say, well, the stock's down the last couple of years. It must be a good buy just because it's Walmart or just because it's the biggest. Stock was $60 a few years ago. It's lost money. You don't think it's going to come back in a big way?
No, I think Walmart has obvious strengths. But again, you're paying about...
And 90% of Americans shop there, according to Walmart.
That may be true. But the Americans who spend their money there are spending money on goods. And there are Americans who are not in the upper tier of the income distribution, so their incomes are not going up as fast as GDP. So as opposed to the, say, 7.5% organic growth that you get at American Express, you're probably looking at 2.5 to 3 at Walmart. And that means that people who are counting on Walmart to produce the kind of 15% growth numbers that they have in the past are probably fooling themselves.
The basic premise being just because a stock, a big player, has gone down or lost money doesn't mean that it will come back in the near term.
And the classic example of that is newspapers. Who thought you could get Gannett for 13 times, 12 times earnings, which is an 8% return, when it had always traded way above that? But that 8% return is in a company that's probably losing 3 to 4% value long term. So you're looking at a net return of 4 to 5%, which is below the market.
So in other words, it's fairly valued.
Fairly valued. I would not
or still over?
Yeah, I would not buy this at this time because the uncertainties just don't justify the likely return you're getting. I think when you look at these growth stocks carefully, what you see is there is a huge range of opportunities. And sometimes it's just self-evident, but other times I think it depends on what goes on. If Walmart got smart and started raising prices by 0.5% a year, and Target followed them up, and Sears followed them up, that would be a 6% growth in earnings as far as the eye can see. And suddenly Walmart would be a much more attractive stock.
All right, but until that happens,
I don't see where the value that justifies the purchase.
Professor Bruce Greenwald, appreciate it.